Chapter 4 problems, and I want to make sure that we're on. Well, I had already done these. Since I received so many inquiries, I did the problems myself, and each time you go in and out of McGraw-Hill Connect, you have the same problems, but then they change the numbers. So the numbers I'm using are the ones that are not here. Well, put it this way, I'm going to use the numbers that are here, but I got to go back and forth from how I did it so that you can understand. Anyway, the first one, they're asking, and let's just show you a problem here. And let me go through my work here. So, yes, forgive me for delaying and seem like I'm scrambling. But for this one, they have a new cover that they can sell for $22. They want the operating profit to be 25% of the cost. Not 25% of the market price, but 25% of the cost. So this is an algebra problem, folks. That's what it is. It's an algebra problem. So, and you know, the way I did it is this. So write this down, please. Take your pencil and write this down. $22 minus 0.25x, because 25x is the cost. So the price minus the cost is going to be a profit. So $22 minus 0.25x equals x. And then if you recall in algebra, you got to add 0.25 to both sides, which will give you 22 equals 1.25x. And then you have to divide both sides by 1.25 in order to get x, which is $17.60. Now they went straight to it. They just took the price and divided it by 1.25. But I had to do it algebraically so as to make sense to me and hopefully to you. You start off with the equation, and I don't know how well you guys did in algebra, but this is very, very basic. You have to be able to write it algebraically. $22 minus 0.25x equals x, and then you solve for x, which is 1760. Okay. The next problem has to do with the backpacks. So let me again. Okay. The backpacks. Now you notice here it tells you that you have a special order for 25,000 backpacks, and instead of paying $66, which is the regular price, this company wants to pay $46 for each backpack. Now if you take the special order, it's going to add $4.60 to your material cost, so that's $18.60 plus $4.60 gives you $23.20. You're going to add an additional $2.10 to labor, so $12.60 plus $2.10 gives you $14.70 as a new labor cost per unit, and then $1.10 in variable overhead added to $5.60 gives you $6.70. So now you have a new variable cost of $44.60. Okay, as opposed to $36.80. That's the variable cost. You also have to buy a machine that's $49,000, and it's going to produce 56,000 units. Test up to 56,000 units. So if you take $49,000 and divide it by the 56,000 units, that's 87.5 cents per unit. And we're going to consider that part of fixed cost. That's part of fixed cost, folks. So now the way I do it, they want to prepare a schedule to show the impact. Now the way they show you here is that they do the status quo and then the alternative. The alternative is adding another 25,000 units, okay, from 456,000 to 481,000. Or you can do, as we said in the PowerPoint slide, you can just simply deal with the difference. So the way I did it is I said, okay, 25,000, these backpacks at $46. So multiply that, 25,000 times $46, and that's $1,150,000. Then what's the variable cost? Well, the variable cost is now $44.60. So if you take 25,000, okay, 25,000, and multiply it by $44.60, that'll be $1,115,000, which gives you a what do you call that, contribution margin of $35,000. That's your contribution margin. Okay? And then we got our fixed cost. Our fixed cost, by the way, is let me see what actually that fixed cost is actually as not just by unit cost, but the fixed cost is the cost of that machine, which is $49,000. So if you take 35,000 and subtract 49,000 from it, that's a loss, if you will, of $14,000. And that's what you see here at the bottom. Okay? So they shouldn't accept the order, basically, right? But you see how I did? Well, you can't see how I did it. But rather than, at least for me, now if you want to do it this way, the way they show it, do it the way it is with no changes, the way it is currently, and then do it the way adding in the special order, which is the alternative, and then subtract the differences and what have you. But I just simply looked at the difference. So I said 25,000 at $46 each. Then the new variable cost is $44.60. We figured that out right earlier, because if you add up all these additional costs to direct material, direct labor, and variable overhead, add the additional cost, you come up with a new variable cost of $44.60 as opposed to $36.80. The variable cost right now, you don't include the $660, that's fixed cost. The current variable cost is the sum of the first three, which is $36.80. But don't forget, the special order requires that you increase the variable cost by the amount stated. So the new variable cost would be $44.60. Multiply that by 25,000 units, and you get $1,115,000. Subtract the variable cost from the sales, and you get 35,000 contribution margin. Subtract the fixed cost of $49,000. That $49,000 is the cost of the equipment. It's the cost of the rental equipment. It's fixed. And so, and then they show you down here how they did it too. And then of course you have a $14,000 loss. So that's how I did it. I just dealt with the difference rather than the long way that they show here. You can do it this way, or you can do it the way that I did it. And now, so question B is, would you accept the order? Of course not. You're losing $14,000 by accepting this order as is. And then the third question is, consider only profit. Determine the minimum quantity of backpacks that make it profitable. Well, the minimum order would be the break-even point plus 1. But what's the break-even point? Well, in terms of the number of units. Well, what is our contribution margin per unit? Well, in this case, the contribution margin per unit you have what do we have? We have 25,000 of these, right? So the contribution margin per unit is 25,000 divided by the 35,000 is 71 cents, 0.7149 actually, 0.71429. That's your contribution margin per unit. And if we take the fixed cost of $49,000 and divide it by 0.71429, and we get let me see, this should be, wait a minute here. I'm trying to see how I did it. The 35,000. Oh, I put the wrong number here. I'm sorry, folks. I'm sorry. If you take the contribution margin of 35,000, contribution margin of 35,000, and divided by the number of units. I had it backwards. I'm trying to go before all of these. It's $1.40. Okay, so if you take your contribution margin per unit is $1.40, right? And that is if you take 35,000 and divide it by the 25,000 units, that's $1.40 per unit. Now, if you know the contribution margin per unit, like I said, you take 49,000 and divide it by 1.40. So 49,000 divided by 1.40 gives you 35,000 units. At least they need to have an order of 35,000 units. At least that, if not more. And here's how they show you to do it. But remember the formula I said for break-even points in units? It is fixed cost divided by the contribution margin per unit. Contribution margin per unit. So the contribution margin was 35,000. The number of units is 25,000. So 35,000 divided by 25,000. That is the contribution margin divided by the number of units. Gives you $1.40 contribution margin per unit. And once you know the contribution margin per unit, then you can simply take the fixed cost and divide it by that, and you get the number of units to break even. So technically, the question is, if you want to be really technical, it says determine a minimum quantity of backpacks if you want to consider profit only. Well, 35,000 units will give you exactly 0 profit. No loss, but no profit. So really, technically, it's 35,000 plus 1. But, you know, that's just being super technical. Okay. Let's go to our next one. Number 3. This is the Davis Kitchen one. Now, this one, folks, it is a doozy. And let me go through my stuff here. It is a doozy. And I think in some respects, it's also unfair. I wouldn't do this to you. But nonetheless, this is the most challenging of the 7. And, well, enough said. Enough said, because some of you have asked me to deal with it and show you how to do it. So I'm going to go back, and it's going to be kind of cumbersome because the numbers I'm working with, and it takes a while, so I can't redo it while we're sitting here. It'll take longer than you would want and I would want. So let's see how we can work this out together. I wish the numbers were the same because it would just be so very easy to explain it. But in any event, here we have, they normally produce 6,000 units a month. And these are the details here, the data for manufacturing costs, including variable and fixed overhead, and your marketing costs, both variable and fixed. And so the total cost there is 311. The example they give me here, the previous example when I went on, and I wonder if there's a way to get to the exact same numbers again. Let me try something, folks. Well, no, never mind. It is what it is at this point. Now, let me walk through this with you, well, as best I can. Here's what I did. For question 1, A, and then goes to A1. Market research estimate that volume could be increased to 7,000 units, okay, which is well within the production capacity. If the price were cut from 372 to 327, assuming the cost behavior patterns implied by the data in the table are correct, what would be the impact on monthly sales, costs, and income? Well, what I did is, first of all, I showed the income statement at 6,000 units. So that would be 6,000 times the sale price. In case the sale price here is 372. My example they gave me was 406, but 372. So 6,000 times 372. That's your sales. All right. Now write this down, folks, while we're going along. And I'm sorry my numbers are different, but anyway, I've already apologized enough. Look at the variable cost. The variable cost is variable material, variable labor, variable overhead, and variable marketing. So add all those up together. And whatever that is, you multiply it by 6,000. Okay? And once you got the variable cost, you subtract it from the sales, and you get contribution margin. Now, I'm not walking through this with you because it would take too long to explain this, because I got to add up the numbers myself. But I'm telling you what to do. You take the 6,000 and multiply it by the selling price of 372 per unit. You go in here and you find what your variable cost is, because don't forget, with the contribution margin income statement, it is sales minus variable cost, all variable cost, and that gives you contribution margin. Then contribution margin minus fixed cost, all fixed cost. So 6,000 times 372, whatever that is. And again, I will work it out with you, but it'll take, again, much longer. Anyway, and then you're going to take the variable cost, material, labor, variable overhead, and variable marketing cost, add up those four, and multiply that by 6,000. That'll give you your variable cost. And subtract the variable cost from sales will give you a contribution margin. Now, what's the fixed cost? The fixed cost is, well, let me back up here. The fixed cost, if you take the fixed cost, and let me do this here for you. If you take 71, I'll do some of it with you, 71 plus the 61 times 6,000 is 792,000. 792,000 is your fixed cost. Subtract that from the contribution margin, and you will get your operating income. You guys with me? I walked you through it. Now, that's what it is at 6,000 units at these numbers here. Okay? And let me double check something to make sure. Yeah. Yep. Okay. Now, let's look at 7,000. But first of all, at 7,000, they're going to drop the price to $327 per unit. So 7,000 times $327 Whatever that is, multiply it out, folks. 7,000 times $327. That's your sales. Now, what would be your, what does it say here? $7,000, 7,000 units. Okay, now you're going to take 7,000 times the variable cost that you already figured out before, right? The variable cost is, because all they're doing is changing the selling price and increasing the number of units. So 51 plus 76 plus 26 plus 26 again gives you your variable cost. Add all those four together and multiply by 7,000. And that's your variable cost. So again, take 51 plus 76 plus 26 plus 26 again. Add them all together and multiply by 7,000, and you get your variable cost. Once you get your variable cost, you will subtract it from the sales, and that will give you a contribution margin. And here's the trick. Don't let this slip you up. The fixed cost stays the same. The fixed cost is well, I think it was 792,000, was it? Yes. No matter how many units, we're talking about the total fixed cost. Not the fixed cost per unit, but the total fixed cost is still going to be $792,000. So if you subtract $792,000 from your contribution margin, it should be a lower operating profit than it was at $6,000. So let's see. Yeah, it should be a difference of $122,000. Okay. You notice here that they dropped the price. The variable cost is different because it's higher because you got more units. Don't forget, unit price of variable cost stays the same. These two fixed costs together is 792. The 366 and the 426. 792. Look at your contribution margin. It drops. Okay. So again, you're going to have a difference of 792. Now, what I did, I just dealt with the differences. Okay. So I hope that explains it. And so, should you accept it? I think the next question is A2. Would you recommend taking this action? No. No. You would not. Okay. Now, let's go here. Number B. B. B, I think I would consider it a bit unfair, but nonetheless, and I'll tell you why. A couple of reasons why. If you look at the same problem in the textbook on page 160, and they have different numbers, of course. The same problem under section B, the very last sentence, which is in parentheses, says, part of your problem is to figure out the meaning of share of March manufacturing cost. Part of the problem is to figure out what I mean by share of manufacturing cost. And then notice here in the explanation of how they do it. Look at B. Assuming the government share is what we see here. And I'll explain all this in just a moment. Assuming it. I mean, I don't know. I just think, why should you have to assume what is meant by the share of March? Suppose you assume something different. You come up with a different answer. So to me, it is just simply unfair. They should have been more specific, so that you don't have to assume anything, unless it's about assumption. Like, sometimes you do assume, but in this case, you shouldn't have to. Anyway, I don't want to continue to bitch and moan, but And again, I did it a little differently also, but that's okay. I think I came with the same answer. But what you do is uh, the way I did it. And boy, I tell you, it's just one day I wish we were in the classroom. They're going to operate at full capacity, right? 8,000 units. Let us suppose they operated 8,000 units with no government contract, just 8,000 units straight up. So it's 8,000 times, in this case, $372. That's the regular price, right? The variable cost, which you figured up here, the variable cost is the same per unit. Multiply that by 8,000 and subtract the variable cost from sales, you get your contribution margin. And the fixed cost is still the same, 684,000. The fixed cost is the same, folks. And so you come up with your operating income. Again, my numbers are different, so that's why. Now, let us assume that you're going to do the 7,000 and then 1,000 government. Now, what they say here, the government contract, let's read what it says here. If it accepts the government order, it will lose 1,000 units normally sold to regular customers. The government contract would reimburse its share of March manufacturing costs plus $49,000. There's no variable marketing costs at all, okay? Now, so the government is going to reimburse you for the variable overhead. First of all, manufacturing costs. So let's take a look here. First of all, what is the variable overhead? The variable overhead is you can do it this way. You take 214 minus 61. 214 minus 61. And so in other words, it's $153 per unit of variable cost. Okay? So you multiply that by 1,000. All right? Multiply that by 1,000, and that'll give you 153,000. Okay? The variable cost, there's no variable marketing, it's just variable manufacturing cost, which is $153, right? That's a 51.76 and 26. Multiply that by 1,000. All right? Then you take let me see how I do that. That's 52. Yeah. You take that fixed overhead of 61 and we're going to multiply that by 6,000. 6,000, folks. And that'll give us 366,000. And then here's where the clincher comes in, which is really the assumption. If they're going to produce at 8,000, 1/8 of that is 12.5%. So you take 366,000 times 0.125, 12.5%, and you'll get 45,750. So if you add the 153,000 plus the 45,750 plus the 49,000 they're going to give you, add those three numbers up. And you get 247,750. If you subtract that, well, that should be the difference. And let me see here. 223. And let me show you how they did it down here. Yeah, $247.750, what I said. And here's how they did it. You see here? They took that 153 is the variable cost, does not include that fixed portion at all. And then they took the 366, which came about from $61, the fixed cost, fixed marketing cost, not fixed marketing, fixed cost, fixed manufacturing cost, and multiply that by 6,000, and it gives you 366,000 times 12.5%, which is 1/8 of the production that they were going to engage in. And that gives you 45,750. So now, I would not do this to you. This is an interesting problem. I don't like the fact that you have to assume and interpret what the government share is. It should have been more explicit as far as I'm concerned. But I hope that by taking you through this, you learn one thing, and that is sometimes you can disagree with how the author of a book presents stuff, and I do in this case. I think you should have been given more information, what the assumption is, more explicit. Anyway, enough bitching. But that's it. Problem B is what probably gave most people some problems here, and I hope I have helped you understand it. And so the difference, of course, is that you would not accept the contract because you're going to be in the hole. You're going to be in the hole by $98,250. Okay? All right. Let's go to C. The C, you got a foreign market that opens up to you. Boy, see, I want to show you how I did it. Here's what you do. You take that same variable cost, the same variable cost. So it's going to ask you, should you, what's the minimum unit price to consider for these 2,000 units? Well, if you were to, where's the 32? 32 here. Yeah. You take the same variable cost, 51 plus 76 plus 26, and add to it the $41 of shipping costs, which is variable cost. Add those two together, multiply by 2,000. And so, in fact, let's work that out together. I think I can do that fast enough for you. 51 plus 76 plus 26 plus the 41 that's in the writing here, $41 per unit. That gives you $194 per variable cost times 2,000. That's $388,000 plus the flat marketing cost of $6,000. That's $394,000. $394,000, and divide that by 2,000 is $197. And there you go, $197. Okay, just the variable cost. Okay, D. Okay. What do I have for D? Okay, D is, what is it here? An inventory. Oh, an inventory of 406. This is interesting too. Oh boy. D, an inventory of 460 units of an obsolete model that remains in the stockroom. So the model is obsolete. What is the minimum unit price that Davis should consider for this order of 2,000? And I'm trying to cover this up here. Okay, not cover it up, but uncover it. What is the minimum unit price that Davis should consider for this order of 2,000 units? I'm trying to read here. 2,000 units at reduced price of inventory will soon be valueless rather. What is the minimum acceptable selling price for these units? Well, you may say, well, what do we pay for? What was the cost? Well, if you own that store and you have 460 units that are just simply obsolete, what cost would you consider in determining what price you will sell them for? Now, it says, what is the minimum acceptable selling price? If you're taking marketing, you'd say whatever the market will bear. But from a financial accounting point of view, you could argue that, well, the cost that I have incurred, I'm not going to recover. These things are obsolete. So whatever it costs me to sell it, if I got to pay a salesperson, see, these must be sold through regular channels. As long as I cover that cost, that's the minimum cost. As long as I can cover my selling cost, what I've got to pay the people to sell it, that's the minimum. And so we go to D, and they say $26 per unit. Where did 26 come from? The variable marketing cost right there. Okay. Now that may not be as obvious, but thinking about it, they're obsolete. You're not going to get you're not going to cover. You may not cover all your costs that you incurred to make it, but at least cover your. They said the minimum cost. If you can sell for more, of course, yeah. But you got to cover your selling price. It's your selling cost, which is $26 per unit. You got to pay somebody to sell it. Okay. All right. Let's go to E1, and E1. A proposal is received by an outside contractor that will ship 2,000 stoves per month to your customers. Now, this also is rather tricky. And if you've done a lot of math and algebra, you probably would have figured it out. But anyway, what is this here? What does it say here? If you let them do that, then it will cut your marketing costs by 20%. My example was, I think, 25%. The stove could be sold for $451, while cost of production would be $276 per unit. Variable manufacturing expense, variable marketing cost would be $51 per unit, and so forth. In fact, why don't we just do this here? Oh, we skipped E2. I'm sorry. E2 is uh, E1 is, that's what it is per unit. And yes, you would accept it. Excuse me, not accept it. How'd that go? Let me go back here. Oh yeah, you're saving that much money, but they want you to pay them $261. No, you wouldn't do that. You wouldn't do that. Now let's go to no there's E1 right there. In fact, let me go up here so you can see. We did C already. I'm sorry, we did D and C. D is the $26 for the variable cost of marketing. E1. Well, your variable cost you're going to save per unit is $153. Look at that. 51 plus 76 plus 26. Okay? That's 153 right there. You're going to save variable marketing cost. What is the variable marketing cost? Let's see here, up here, by 20%. So 20% of that is, so you save $5.20 per unit. And the fixed manufacturing cost saved is 45. And wow, here's how they did that. They said here, up here, excuse this, I don't know what this, up here they say that E1, the plant would operate at 2/3 of its normal level. 2/3, right? 2/3. And the fixed manufacturing overhead will be cut by 25%. Okay? So first of all, fixed manufacturing costs will be cut by 25%. So fixed manufacturing cost is $61, right? That's it, $61. So if you take $61 times, excuse me, I gotta keep reading this up here. Cut by 25%. So that means it's gonna cost you 75%. 0.75 is 45.75, and divide that by 0.3333, and they got it at 137. What is that? F1? No, E1. I'm sorry. And I'm trying to go between my numbers and theirs. So 61. Just bear with me here. Yeah. How to get the 45.75? We got the variable cost, right? You add up those three numbers to get 153. We know that they're going to save 20% or was it 25% off of variable marketing. But where did they get the 45.75 from? Well, it said that the fixed overhead is $61. Okay, fixed manufacturing is $61. See up here? All right. If you take 61 times 0.25, that's the savings. 0.25, that gives you $15.25. Then here's where the clicker comes in. and they don't show you. Well, they show you a different way, I guess. The way I figured it out is I divide, if the manufacturing cost, if you're going to operate at 2/3, that means you're saving a third. So 15.25 divided by 0.3333 is 45.75. Because you're operating at 2/3, you're saving 1/3. 1/3 is 0.333. Now, the way they show it as 366,000 minus 274, 500, and then divide that by 2,000 units. I just did it a different way, different concept, different way of viewing it. That's how I would do it. But again, the way they've done it is different, but we came up with the same answer. And so you're saving $203, but they want you to pay them $216, so you reject the order. Okay? You reject the order. Now, let's see here. And let's go to F1 and F2. Again, you go through the same process in terms of what you save. And they show you here in the detail. The contribution margin, if you take the sale price, and I did it. I'm trying to show you how I did it, but I can't show you how unless I can tell you how. I took the sales minus the variable cost, manufacturing variable cost, and the variable cost for marketing. I came up with a contribution margin, if you would. And my example was, let me see if I can do it their way using their numbers. F1. Okay. Proposal received for 2,000 stoves, and then that will fee you up to make 1,600 modified stoves. So what I did is I took the 1,600 modified stoves at the price and multiplied them by the selling price. Then I took my variable cost, total variable cost, my variable cost per unit, and multiplied that by 1,600. And I came up with a contribution margin, and then I divided the contribution margin by 2,000. And that'll tell me what I earned or save, if you would, by freeing up that space to do these modified ones. And compare that with the savings, or compare that with the payment to the outsider. And so well, folks, again, we come up with the same answers. It's just that I did it so differently. Because I tried to do them without looking at the answers. And, of course, I came up with the same answers. That's a good sign. Except that I did it, again, differently. I just concentrated on the difference. And I wish... What I should have done, I suppose, is to do my work on Excel. Let me put it this way. If you are still not clear about this particular problem, then I will submit it on an Excel with my numbers, because then it'll be easier to explain rather than using different numbers. I can tell you what I did, and hopefully how I explain it is clear enough. But if you want to see the actual numbers that I used to do it, the actual numbers that were given me when I went into it, I'm willing to do that again, and on Excel if I have to. Just let me know if I need to. Okay, let's go to the next one, which is number 4. And number 4 had to do with, again, the wheelchairs. Let's see here, wheelchairs. Yes, okay. Make or buy decision, wheelchairs. Okay. Now, first of all, what I did, it was 1800, yes, 1800, same number of units, it just changed the price. So what I did, folks, here's how I handled this one. I took 1800 times 28. In fact, why don't we do this together, because it's easier or quicker. Well, but maybe my explain. The reason I'm concerned about the time is it takes, because I got to upload all of this, and by the time I finish this lecture, it's going to take at least 3 to 4 hours to upload it all onto, I have to process it and everything onto YouTube, and that's another 4 hours that I got to babysit the machine. I can do other stuff, reading and stuff, but anyway, never mind. I took 1800 times 28. I gave my direct materials. 1800 times 101. 1800 times 17. And then let's see here. 1800 times I'm trying to make sure I got this right here. And that's the fixed overhead. 1800 times, should be the last number there, times 39. Is it 30? Oh, 40. Okay. So in other words, and I constructed a what is it here? I constructed a contribution margin schedule or income statement. Let's see. Now, this company offers to sell the assembly for $160 each. The total order would amount to 1,800 rear wheel assemblies per year, which Mobility's management will buy instead of make if they can save at least $20,000 a year. They want to save at least $20,000 a year. Now, accepting this order would eliminate some of the fixed overhead, $35,950. Okay, so they want to save at least $20,000 a year before. Otherwise, they won't even consider the order. Okay, so you got fixed cost. You got fixed cost here of 1,800 times 40, That's 72,000 in fixed costs, right? And that's they're still going to have that $72,000. Then you got, and I want to make sure I got this, giving you the right information here. Yeah, and the variable cost they would save is 28, well, let's say minus 4, 140, 146, 146, 146 times, yeah, 146 times 1800. Okay. Now, they would in fact would save 300,000. Let me get this down here. Right now, the way things are, this is what it is based on the chart. This information up here above. What they would save, you get $35,950 saved, which means you're still going to have $36,050 of overhead. Still going to have it. So that savings they're going to pay. See, I just do the difference here. The total cost is $334,800. You figure that out by what I set up above. Multiply each of these numbers by 1,800. Right? 1,800 times each of these will give you this information here. This is what it's going to cost you if you buy from them, and you're going to still have this much overhead. So that plus the overhead you're going to keep, that's the price. I mean, that's your cost. Okay? So should you make or buy? Well, you look here. And the answer is no. Okay? This is your this is your total cost right now. But what are you selling it for? Well, what is the price? The normal price is, I mean, basically here. What is the price? Oh, 160. Okay. So what they did here, they want to save at least $20,000. They're not. They're going to save $10,000, $750, but they want to continue to make it. Then they have a threshold to save at least $20,000. Here they save 10,700. Okay. Let me see here. I want to double check something here. And by the way, you need not consider what you're selling it for. This is your cost. They want the cost. They want to save at least this much. So just looking at the cost. Okay? This is not profit. This is simply cost. And they save money, but not what they wanted to save. Okay. All right, number 5. Is it 5? Yeah. And here we have the product mix slaving. Okay. I got slaving here too. And alpha in the data. What you have to consider here, it's a contribution margin per machine hour. Okay? You see the contribution margin of 66 and 71? But look at the machine hours. It takes a half hour longer to produce this one, even though it has a higher contribution margin. But if you take 66 and divide it by 2, you get 33. You take 71 divided by 2.5, and you get 28.4, or $28.40. So alpha has a higher contribution margin per machine hour. And therefore, you should produce as many of these as you can, alpha, and then the rest will be data. Or delta, rather, not data. Delta. So, maximum demand, you go with 180 for the price they sell it for. Alright, so 180 times, that's maximum, at 125. That's 22,500. And then that would take how many machine hours? It takes 360 machine hours. 180 times 2, it'd be 360 machine hours, leaving 140 machine hours left for delta. Okay, and so you can produce 56 of those, and that would be times 155, and that's another 8,000. So altogether, your profit would be just over 30,000. You see 180 units and 56. Okay, and again, just to show you how I got that, since alpha has a higher contribution margin per machine hour, you want to produce as many of those as you can, and that the maximum is 180. Okay, so 180 times $125 is $22,500. Okay, and so you're going to produce 180 of those, and 180 takes 360 machine hours, 2 machine hours per unit. So 180 times 2 is 360 out of 500 available hours, which is 140 hours left. And 140 hours, and there's 2.5 machine hours per unit. That would mean it would be, you can produce 56 units. And then 56 times 155 is 8680. And so that gives you your profit after you subtract the cost here, your fixed cost. Okay, and there we go there. So it's based on contribution margin per machine hour. So next would be number 6. Again, this theory of constraints. And that would be what, what's this theory of constraints here? I'm trying to find it. Okay. Makes a single model of ergonomic desk or the chair for computer usage and so forth. Desks are manufactured in one building and chairs in the other. So, what's the bottleneck? Well, it'll be building one. And you can see the capacity for building one is simply 400. And you're not going to produce any more chairs than you will desk. So that limits even the production of chairs. So now they can increase the capacity at 100 desks a month by producing on a weekend. Variable costs per unit would increase by $26 because of the labor, and fixed costs will also increase by $20,200 a month. So what should you do? Well, here, what is it, 303? Okay. So let's say that you produce 100 more chairs at 303. So 100 times 303 is 30,300. All right. Now your variable cost is going to increase by let's say variable cost per unit will increase by $18. So, oh no, I'm sorry, 18. I'm reading from my stuff. Increased by $26. Okay, because of the labor. So that's an additional 2,600. Let's see, yeah. Your what is it here? Oh, each have a variable cost of $126 each. So now it's $152 times 100, right? And then you have also your contribution margin would be 3,300 minus 15,200. Contribution margin is 15,100. But your fixed costs will also increase by 20,200. So no, you would not do it. Well, by $5,100, like I said. See here? You did 100 times 303. Your fixed cost went up. Your variable cost is 15.2 because it went up by another whatever it said it was, $26. So you're losing. You lose $5,100 if you go that way. But now the next issue is, so it shouldn't do a weekend right now. Now here, if they add additional equipment and workers in building one, they can make 100 more. As I'm looking at C now, this will not affect the sale price for a variable unit would increase by 500. This will not affect the sale price or variable cost per unit, but would increase fixed cost by 15,100. Okay. So we still got the $100 times, 100 desks per month times the 303, 30,300. This would not affect sale price or variable cost per unit. So the variable cost per unit would be the same. What was it? 126. So that's 12,600. That gives you a so 30,300 minus the variable cost gives you a contribution margin of 17,700, and your fixed cost would increase by 15,100. All right, 15,100, and that'll give you an increase of 2,600. See what I did? Well, I can't see what I did, but again, the selling price is 303 times 100 is 30,300. Write that down. Oh, I got it here too. Your variable cost is the same, $126 per unit, 12,600. That gives you a contribution margin of 17,700. Your fixed cost is 15,100. So the difference is 2,600 increase in profit. Okay, and this the last one here, Charlene, whoever her name is. Okay, this has to do with wedding gowns. Yeah. Okay. Again, the way I did this, folks, and again, is okay. She makes wedding gowns to custom and also standard ones. So it'll be people buy them off the rack. And as you can see here, she makes twice as many standard as she does custom. A special order comes in and says, look, I got a special order here, and these are the circumstances. It's all here, okay? And I look at it this way: what would she give up by taking this order? What does she give up? Okay, well, she's going to give up 10 dresses, 10 standard dresses. Which again is half of that 31,000. So she's going to give up $15,500. Okay. She's going to give up the associated variable cost with that. So she's going to give up. I'm going to subtract that, but she's going to give up $4,100. All right. You will not incur the $9,200, so that's $4,600. And the $320,160. So the variable costs associated with those dresses would be $4,100 plus $4,600. Put the wrong number in. $4,100 plus $4,600 plus $160. So that's $8,860 that will not be incurred. And if you take $15,500, which is half the standard dresses revenue, minus the $8,860, that's $6,640. Okay, you got that? So we got 6640 there. Now on the other side, if she accepts that order of the dresses to replace that, let me see here. Yeah, so she's willing to pay $25,000. The direct labor will be $6,200. The direct material, or direct labor, direct material is $10,200. Yeah. And the overhead, is 160 machine hours, and it's I think it's $1. I'm trying to read this here. I think it's $1 per machine hour, or $160. So let's see what the contribution margin is by accepting the dress, the special order. 25,000 minus $6,200 minus 10. No, that's 60. Yeah, 10,200 minus 160 is 8440. So minus the 6640 that she gave up, that's $1,800. Oh, I got 1812. Let's see, did I do something wrong here? I got $1,800. I did it a different way. Let's see here. I'm off by $12 from them. So let's go back. If she gave up half of the standard, that's 15,500. Giving up 4,100. Giving up 46. 160. Okay. So 4,100 plus 4,600 plus 160 minus 15,500. That's 6,640. If she accepts the order of $25,000, that's 6,200. Well, what did I do here? Yeah, 10,200. Oh, 148 hours. I'm sorry, that's the difference of $12 right there. I misread that. 148. So it's 84.52. 84.52. So in other words, if she accepts the order, she has a contribution margin of $88,452, and she would have given up a contribution margin of $66.40. The difference being $1,812. So she's ahead by $1,812 if she accepts the order. And that's what you see here. And so question C is, what is the minimum price she would pay or should accept? What do you think it would be? What's the minimum? What do you think it should be? Well, let's take the 25,000 minus what she gave up. 25,000 minus 6640, and that would be Oh, the difference, 1812. 25,000 minus the 1812 would be the 23,188. That's the minimum. Otherwise, that's what she'll break even then. Okay, that's that. Very interesting. Normally, I go on and I do the problems with you, or at least right then and there. I call myself doing it in advance because there were some special questions people were asking about it, and I want to see what the issues were. Glad I did, but when I went back in, of course, my numbers are different. So hopefully in the future I can do it as I'm doing it. I won't make that mistake in the future. I won't do it in advance, is what I'm saying. I'll do it along with you. And that way we're using the same numbers. If you have any questions, though, please feel free to email me or my SI. Either one is fine. And I hope you have a safe Memorial holiday. Be safe, though. Stay safe. We've lost too many people. I mean, there are people I've known, several people have lost to this ugly disease. In fact, one of our instructors, adjunct instructors, passed away. And anyway, just be careful. Take care.